Hi, I'm Warren with Warren's Money Buffet. Today we're going to tackle one of the hottest debates in investing right now. Should you try to pick the next artificial intelligence superstar stock? Or should you just buy an AI exchange-traded fund and let the whole sector work for you? If you've watched the news, you know AI is everywhere, powering your phone, your car, your doctor's office, and maybe even your portfolio. But when it comes to investing, is it smarter to bet on the next NVIDIA or to spread your money across a basket of AI innovators? Let's dig into the numbers, the psychology, and the real-world results of both strategies, so you can make the best decision for your money and your sanity. Let's start with a story. Last year, my friend Sam called me absolutely fired up. He just watched NVIDIA's earnings call and was convinced it was the only stock worth owning. He said, "Why bother with exchange-traded funds? I just want to own the winners." But a month later, NVIDIA dropped 18% in a week, and Sam was texting me in a panic. Meanwhile, my cousin Jess had quietly bought a basket of AI exchange-traded funds. She barely checked her account, but her portfolio kept growing, slow and steady. So who's right? First, let's define what we're talking about. An exchange-traded fund, or ETF, is a basket of stocks you can buy with a single click. An AI ETF focuses on companies leading the charge in artificial intelligence. Think chip makers, software giants, and up-and-coming innovators. Individual AI stocks are, of course, the companies themselves: NVIDIA, Microsoft, Palantir, C3.ai, and so on. Let's look at the numbers. According to US News and NerdWallet, the top-performing AI ETFs for the past year include ARKQ, up nearly 29%, QTUM, up 28%, and EBIZ, up 21%. Others like AIQ and FDN and BOTZ have returned between 9 and 18% over the past 12 months. These funds hold dozens of companies, from the so-called Magnificent Seven, Microsoft, NVIDIA, Alphabet, Meta, to smaller names riding the AI wave. But how do these compare to individual AI stocks? Let's take NVIDIA, the poster child for AI. In the past 5 years, NVIDIA's stock has soared over 1,000%, making early investors rich. Microsoft, another AI leader, has gained nearly 300% in the same period, driven by its investments in Azure, OpenAI, and enterprise AI solutions. Palantir, a pure-play AI software company, jumped 340% last year before pulling back in 2025. But not every AI stock is a winner. C3.ai, SoundHound, and quantum computing have all seen wild swings, with some losing over 50% from their peaks. So, what's the catch? Why not just load up on the hottest AI stock and call it a day? Here's the reality. Picking winners is hard. For every NVIDIA, there are dozens of AI companies that fizzle out, get acquired, or simply can't keep up. The S&P 500's returns over the last 2 years were driven by just a handful of mega-cap AI stocks. So much so that the Magnificent Seven now make up nearly 35% of the S&P 500's market cap and have driven over 70% of its returns since 2023. But that kind of concentration is risky. If one of those giants stumbles, your portfolio can take a big hit. Let's break down how AI ETFs work. Take the Global X Artificial Intelligence and Technology ETF, ticker AIQ, for example. It holds 85 companies, including NVIDIA, Microsoft, Meta, Apple, and Alibaba. The Roundhill Generative AI and Technology ETF, ticker CHAT, is more concentrated, with just 38 holdings, but it's actively managed to focus on companies with the highest AI exposure. These ETFs rebalance regularly, so you're always holding the current leaders in the space. What about fees? Most AI ETFs charge between 0.35% and 0.75% per year. That's higher than a plain vanilla S&P 500 index fund, but much lower than the average mutual fund or hedge fund. And you get instant diversification. If one company crashes, the others can pick up the slack. Now, let's talk volatility. AI stocks are some of the most volatile on the market. In 2025, the iShares AI ETF dropped 20% during a market sell-off, twice as much as the S&P 500's 10% loss. Individual stocks like Palantir and C3.ai swung even harder, with 30% moves in a matter of weeks. If you're not comfortable with roller coaster rides, an ETF can smooth out the bumps. But there's a trade-off. When you buy an ETF, you get the average return of the group. If Nvidia jumps 40% in a month, your ETF might only go up 8%, because it's diluted by the other holdings. On the other hand, if a stock like SoundHound drops 50%, your ETF barely feels it. It's the classic tortoise versus hare scenario. Let's do a side-by-side comparison. Imagine you invested $10,000 in the ARK-Q AI ETF at the start of 2024. By May 2025, you'd have about $12,883, a 28.8% gain. If you'd put the same $10,000 into Nvidia, you might have seen your money double at the peak, but if you bought at the wrong time, you could be down 20% or more in a single quarter. Microsoft, more stable, would have given you about a 25% gain over the same period. Palantir? You could be up 340% if you timed it perfectly, or down 30% if you bought the top. So which makes more money? Over the long run, individual AI stocks have the potential for much bigger gains, but also much bigger losses. ETFs offer steadier, more predictable returns, but you'll rarely hit a home run. Let's talk about psychology. Picking stocks is thrilling. You feel like you're on the inside track, hunting for the next big thing. But it's stressful. You're glued to earnings calls, news alerts, and Reddit threads. One bad quarter can wipe out a year of gains. ETFs are boring. You buy, you hold, you rebalance once or twice a year. You sleep better, you spend less time worrying, and you're less likely to make emotional mistakes, like panic selling during a dip or chasing a stock after it's already run. There's also the question of timing. AI is still in its early innings. According to industry analysts, we're just at the beginning of the AI adoption curve. That means there will be more winners and more losers ahead. The best AI stock of 2030 might not even exist yet. ETFs let you own the whole field, so you don't have to guess. But what about taxes? ETFs are generally more tax efficient than buying and selling individual stocks, especially if you're trading frequently. Many ETFs use in-kind creation and redemption, which helps minimize capital gains distributions. If you're holding in a taxable account, that can make a big difference over time. Let's not forget about international exposure. Some of the best AI ETFs, like XAIX and AIQ, hold companies from Europe, Asia, and beyond, not just the United States giants. That gives you a broader play on global AI adoption, which could be a key advantage as other countries ramp up their own AI investments. Now, let's address a common myth. If I just buy the top AI stock, I'll get rich. The reality is, even the biggest winners go through brutal corrections. Nvidia, for example, dropped more than 50% in 2022 before roaring back. Palantir soared 340% in 2024, then gave back a third of those gains in early 2025. If you can't stomach those swings, you'll likely sell at the worst possible time. So what's the best strategy? Here's my advice. If you're new to investing, or you want exposure to AI without the stress, start with an AI ETF. You'll get diversified exposure, lower risk, and a smoother ride. If you love research, can handle volatility, and want to swing for the fences, allocate a small portion, maybe 10 to 20%, to individual AI stocks you believe in. But always keep the core of your portfolio in broad diversified funds. Let's talk about the risks. AI stocks and ETFs can be expensive. Many trade at high price-to-earnings ratios, which means they're priced for perfection. If growth slows or the market gets spooked, the drop can be fast and deep. There are also regulatory risks. Governments are starting to regulate AI, especially around privacy, data use, and monopolistic practices. That could hit some companies harder than others. There's also the risk of hype. The term AI is slapped on everything now. Some companies are more marketing than substance. The SEC has already fined some firms for misleading investors about their AI capabilities. Always look under the hood. Does the company actually use AI in a meaningful way, or is it just buzzwords? Let's look at some real-world ETFs. The Global X Artificial Intelligence and Technology ETF, ticker AIQ, holds 85 companies and charges 0.68%. The Roundhill Generative AI and Technology ETF, ticker CHAT, is more concentrated, with 38 holdings and a 0.75% fee. The iShares Future AI and Tech ETF, ticker ARTY, holds 50 companies and charges 0.47%. The L&G Artificial Intelligence ETF, ticker AIAI, tracks the ROBO Global Artificial Intelligence Index and focuses on machine learning and predictive analytics. The Wisdom Tree Artificial Intelligence ETF, ticker WTAI, tracks the Nasdaq CTA Artificial Intelligence Index, with holdings in robotics, big data, and cloud computing. How have these performed? In 2025, AI ETFs have been volatile. The best performers, like ARKQ and QTUM, are up about 28%. Others, like the Global X Artificial Intelligence UCITS ETF, are down 5%. The X-Trackers, Artificial Intelligence and Big Data UCITS ETF, was down 3.7% in 2025, but up 61% the year before. The lesson? Even ETFs can be bumpy, but they smooth out the wildest swings of individual stocks. Let's talk about the S&P 500. The S&P 500 already has heavy exposure to AI since the Magnificent Seven: Apple, Microsoft, Nvidia, Alphabet, Meta, Amazon, and Tesla make up 35% of its market cap. If you want extra AI exposure, an ETF is a great way to tilt your portfolio. Let's do a quick Q&A. Can AI ETFs really keep up with the hottest AI stocks? In bull markets, no. Individual stocks will often outperform. But over the long run, most investors will do better with the steady, compounding returns of ETFs, especially after accounting for risk and taxes. Are there any downsides to AI ETFs? Fees are slightly higher than plain index funds, and you'll never get the 10 times winner effect. But you'll also avoid the 80% wipeouts. What are the best AI ETFs right now? Based on 2025 data, top performers include ARKQ, QTUM, AIQ, BOTZ, and CHAT, with annual returns ranging from 13% to nearly 29%. Each has a different focus, some on robotics, some on software, some on global leaders. Should I just buy the S&P 500 instead? The S&P 500 already gives you plenty of AI exposure. If you want to bet bigger on AI, an ETF is a smart, diversified way to do it. What about the future? Is it too late to invest in AI? Not at all. We're still in the early days. But don't chase the hype. Focus on long-term trends, and remember that diversification is your best friend. Let's end with a challenge. This week, compare the top holdings of your favorite AI ETF to the individual stocks you're most excited about. Ask yourself, am I investing for excitement or for long-term growth? There's no wrong answer. Just make sure your strategy matches your goals and your risk tolerance. In the end, the best portfolio is the one you can stick with. For most investors, that means letting the ETF do the heavy lifting, and maybe using a small slice of your portfolio for those moonshot bets. AI is changing the world, and with the right approach, it can change your financial future too. Thanks for listening. If you learned something, hit subscribe and let me know in the comments. Are you Team ETF or Team Stock Picker? Next week, I'll show you how my $8,000 vacation cost my portfolio thousands and how you can avoid my mistakes. See you then.